Welcome to the Crypto Podcast. You can find all our episodes on thecryptopodcast.org. My guest is a growth expert and fund manager, crypto founder of CKC.Fund, a partner and board director of ChainBLX. He's living in New York, but I think from California originally. Please welcome David Doss.
Thank you. Great to be here.
So, instead of going into all the crypto thing and asking you where your crypto started, there was a few things that I saw that were interesting for me. One, you speak 7 languages, which is always very impressive.
Very, very kind. I guess in terms of languages, I think something I'm really passionate about is connecting people around the world. And so that's something that ultimately to me is part technology and part kind of relationship, right? So that's actually to me part of what helped me to kind of fall in love with the blockchain and digital asset space, is just spending a lot of time around the world looking at how people are in their everyday lives, and then seeing that's not necessarily how their digital life is or how their money is. So seeing this kind of crazy, big, beautiful world that we live in and being able to talk with people in different corners of it is, I'd say, kind of what part of what motivates me personally, but also professionally.
Very good. The other thing is, I don't know what your total is now, but I saw 70 plus countries, which is always impressive as well. So I presume with going around and going to events helps, but where is the place that has touched you the most that you'd say people need to go here?
Well, it's an interesting question. I guess it's hard to just name one. It's kind of feels like trying to say who's your favorite child or something like this. But
you tell each of them it's them, not to tell the others.
Yeah, exactly. Like the musician or the comedian coming in and saying, I love you, Germany. You're my favorite country. And then on the next stop on the tour as well, is also the favorite. But I would say from a standpoint of more kind of personal side, I really enjoy. I enjoy a lot of different places. But then from more of the kind of the professional side, I think there's huge opportunity around digital assets in kind of 2 key areas. One is the kind of what they're calling the new Silk Road, in the sense of the kind of the silk trade from several hundred years ago sort of thing, which would be a lot of these small nation states around the world. So you've got these kind of clusters building up in places like the Gulf Coast, Arab Emirates kind of leading the way in that region. And then you've got also in Asia, Southeast Asia, your Hong Kong, Singapore, also really kind of catalyzing a lot of innovation. And then also you have kind of similar small countries in Europe that are leading the way, say Liechtenstein, Malta. And then we've also got kind of similar phenomenon in the Americas, in the Caribbean, with say the Cayman Islands or British Virgin Islands, as well as Bermuda, although I guess it's not technically Caribbean. But that's also where a lot of my time has been lately, is in conferences in kind of those clusters that are starting to really attract innovation. And then another area that I think I'm starting to spend more time in is kind of more emerging markets, where there's more opportunity to leapfrog on technological innovation, where some of the kind of established players, we see this a lot just in general with technology, established players, they're not as interested in, adopting innovation until they're not interested in driving the initial wave of adoption. Say with cell phones, the US had super developed landline infrastructure, probably best in the world. So they weren't really incentivized to kind of double down on mobile technology. And so you saw all of a sudden certain countries with, kind of historically less communications infrastructure just shoot way ahead on the mobile side before the US did. I think we're starting to see something like that with the blockchain and digital asset space with some of these emerging markets. And then I guess lastly, Europe, because my wife loves Europe. So also spent a lot of time there.
Brilliant. And I mean, I want to know your full crypto journey, but there's one other personal thing that I'd love to know: fencing, because apparently you're very good at it, and it's something that I've never done, but I've always wanted to do it. So it's like, how did you get into that? And I presume that's the fencing with the mask on it, and you're kind of like,
Yeah, exactly. So the black mask, white uniform, sort of a pain to keep clean. But actually, side note on that, the reason why they had the white uniform back in the day was that they would dye the tips of the weapons,
so
like a red dye, so you'd see when someone actually hit. But then it kind of took on a life of its own. But yeah, I guess the why for that originally was probably just being a little boy and liking the idea of a sport where I could run around hitting people with swords and not get in trouble is I guess part of that. But then it also, I think it ended up being part of the question of community, where I think a lot of these kind of more niche sports, it's kind of this ready-made community wherever you are around the world, where you show up and you're with your own, kind of, whether you're in Europe or Africa or Latin America or what have you. So I think that's been also something really special to have.
Does it actually hurt when somebody pokes you with it?
That's it depends on it. It can really hurt. I mean, I'd say it's extremely safe, but it's also it can really hurt. So they make them the weapons from this steel called maraging steel, which is super bendable. It's what airplane screws, for example, or airplane springs are made out of. So very resilient. You could bend the weapon in most cases all the way from the tip to the hilt, like make a full arc, and it might not break. But yeah, I mean, you get a lot of bruises. Let's just put it that way.
Let's get into the whole crypto thing. How, when you learned about it and start getting into it?
Yeah, well, I mean, I guess that kind of ties into one of your questions from earlier of just kind of that global, global background that, for me, I grew up, like you said, in Silicon Valley in California. So, kind of grew up amid the backdrop of the tech ecosystem boom and bust with the .com era, as well as the real estate market boom and bust around the region that was kind of happening at various points, and was really interested in innovation, but also in alternative assets and things like that. And so going from that into, living, working, studying in different countries around the world, and then also working in finance, technology, digital economy, I just saw a lot of ways in which people were not able to really get the job done properly, so to speak. I mean, you see in the United States, for example, even just sending money from state to state, there's in kind of a legacy system, there's a lot of rails in place that it's almost like in some cases there can be differences in the state level that are almost as big as differences between some countries, let alone going country to country, right? And then you see also, things like basically inflation around the world that, countries increasingly, fighting this problem, before COVID as well as after it. But point being that, there are a lot of regions in the world where people don't have the confidence to just put all of their money into the cash of their national bank ecosystem. And then lastly, also just seeing what I was really fascinated with in university was researching bottom-up social movements and how those can impact change around the world. So I was really fascinated with decentralization before I knew what blockchain and what Bitcoin were. So I guess that interest in alternative investments from an early age, plus the international background, plus professional background in tech, security, digital economy, etc., it's kind of this critical mass moving me towards the space, and I've been involved with it for 7 going on 8 years at this point.
And the company then, CKC.Fund. So you might explain exactly what you're doing in that.
Yeah, so CKC is a fund and asset management group, as well as a program management and consulting group. So on the fund and asset management side, we manage various vehicles and basically client portfolios in the digital asset space. So what we're looking at is basically bringing that same level of rigor and transparency to digital asset management as people in kind of the regular world, so to speak, might expect from their, stocks portfolio manager or something like this. And then on the program management side is helping businesses with their blockchain, Web3, tokenization, and related needs.
And I mean, I suppose with the cybersecurity, because I just got an email there earlier, Christie's, the auctioneers, they've been hacked recently, and there's a data breach, and there's always that fear there. So I'm just curious, what do you do to kind of protect the customers?
That's an important point. So on the asset management side of things, there are a couple of different key areas in place there. So one of them is that the kinds of systems and partnerships that a kind of the professionals like us will use are different than what you might be using on a day-to-day basis. So, having the let's say a normal kind of regular everyday crypto transaction, a lot of people will just park things on exchanges, for example, but then that could be a vulnerability point where there are hacks that happen from third parties, or there are exchanges that go bust as well, right? And so then that can leave people very vulnerable. That's just an example, but in more of a kind of professionally managed solution framework, what we do is we focus on basically frameworks where assets are held off exchange, as well as frameworks where things are insured against the kinds of scary things you read about in the news. So other areas would be to have basically multi sign-off protocols, where basically you need to have 3 different organizations, for example, sign off on a transaction leaving a wallet before it actually does, to prevent someone, say, going in and swiping someone's information or things like this. So it ultimately comes down to kind of a chain of custody and kind of approval protocols, as well as insurance and kind of let's say security framework protocols that the average person just signing up for an account that they Googled, might not be able to access.
And I know what you mean by the insurances, that you've got like different systems in place, but is it possible for people to have insurance when there is a genuine mistake, or if there was fraud involved where somebody's actually, given the wrong website and things like that?
Yeah, so it's a sort of thing where there are multiple, multiple different things that you can insure against, which include things like, let's say, fraudulent activity by someone on an exchange team that's like a service party provider, or a hack where someone's coming in and taking the money and running, or also failure of a smart contract, which is rare but happens, as well as, there are many different ways to potentially do something like that. It's ultimately something that's often not technically or financially feasible for any one person on an individual level, but when it gets up to an institutionally managed account level, can be more feasible, essentially, where let's say, for example, if if an individual is doing something like this might just cost them much more than they're willing to spend themselves. But if it's a group overall, then it scales well. Kind of the cost benefit is a lot more there.
And what kind of exchanges and wallets would you actually recommend? Because I mean, there's a few of them out there, and everyone has their own kind of favorite for the wallet.
Well, it's an interesting question. I would say, well, firstly, just as a disclaimer, I'm not an investment advisor, so this is not legal or
that's only for the American people. The rest of the world don't care about these things.
I know that's I was on one of these calls the other day, and I was on a call with a colleague, and I said something like that, and he rolled his eyes, and he's like, "Oh, you Americans." Yes, but anyway, we're conscientious. But what I was going to say was, I mean, in general, I would say think through the job that you want to be done and what your goals are. I would say there are a couple of different general categories. So, one would be, do you want something where you have a third party that can help you with this? In which case, something like a centralized exchange, could be relevant, where, you forget your username and password or things like this, then you want backup, then that's where I would go. If you're looking at something that's more kind of really, really offline, then a lot of people will choose more kind of a hardware wallet, like a ledger or similar. But and then beyond that, I think there's the thing is that there's at least a dozen different ways to kind of solve that problem, and it's so specific to what people's needs are. But generally speaking, would say try to have either direct access to your own private keys, or else be very sure that whoever has access to your keys, such as an exchange or service provider, is a group that you can really trust and that you've done your due diligence on.
And with like decentralized the finance and just kind of crypto to crypto, like kind of not showing everything. But the problem is you have to go into the exchange and you have to give your passport and you have to give your even utility bills and stuff like that. So the reality is it's not. It's like there's no privacy as such.
That's a great point, actually. I think that's kind of a frequently asked question, is from more kind of the crypto detractors, from folks who ask about, this space and are interested in investing in the space, is, crypto and sort of criminal activity, etc. And I think there are a couple of relevant points there. Firstly, I absolutely agree with you. There is a huge difference between anonymity and pseudonymity. So most cryptocurrencies and digital assets are not anonymous; they are pseudonymous, and as such, it's actually very easy in many cases for governments, regulators, tax bodies, things like this to track the movement of cryptocurrencies. Talked with friends and colleagues in various of these types of governmental organizations, and often they have 2 or 3 different solutions for this. They have 1 or 2 that they built in-house, and then they have a third-party service provider as well, so they can cross-reference basically multiple analytic systems to tell who is this likely to be, where is the money flowing, things like this. And so in that regard, I mean, there's always with any asset, there's the risk of illicit activity, but if anything, I would say things like cash or more offline assets such as real estate, artwork, are actually harder to track in many cases than these online assets with a public ledger. And then the other part is just thinking through kind of the percentage of illicit activity. I mean, I think that there was an interesting kind of let's say debate at the beginning, say, of the Russia-Ukraine conflict, that digital assets are going to become something where it's kind of, let's say, way more in support of kind of the aggressor, things like this, to move money. But then ultimately, something that was very interesting that ended up happening there is that there were millions on millions of dollars moving through digital assets to, say, support relief efforts in Ukraine, things like this, where actually various kind of trusted analysts were estimating that there were about 40 times as many kind of assets in the form of crypto moving towards relief efforts in Ukraine as there were, say, towards let's say funding arms and weaponry on the Russia side. So I think that's just an example, but I think is interesting, where kind of people's assumptions do not always kind of correspond with the reality of the situation.
I find it's kind of strange when, like, I've had a lot of guests that have been scammed. Like one guy, 100,000. There's a friend of mine, 500,000 he got taken from him. And it's like, the reality is, like, you know, even with the AI, they could trace it. But even like the how does it, phishing, or where they've the different websites. I mean, are they clever enough to even? Because when you register a domain, you have to give your details as well, and you have to pay for the domain. Like, so there's traceability for everything, but it seems like it's only the taxman when they get involved with the FBI or whatever illegal. You know, like when it's your own personal thing, is like, oh, that's your problem. The criminal police or whoever doesn't want to get involved. It's like, they don't care.
Well, I mean, I think it is tricky in that regard, because I think that a lot of those kind of like enforcement agencies are inundated with activity and issues. But I think it comes down, it's not something specific to crypto. Think about it in terms of let's say if I were to file in many jurisdictions a police report because someone stole my phone, it's like, well, okay, we'll keep that on file, but in most cases, not going to hold your breath on that, right? But if it's something where it's kind of large enough that that there's a critical mass, or where it's affecting multiple people, then I think that that becomes more of an effort. Where, I mean, like anyone, I think a lot of these enforcement agencies are looking to provide the most good to the most number of people. So if it's something where it's this same situation has affected multiple people, they'll kind of pool resources together or something like that. So I guess as an individual, when it's kind of on the smaller size, sometimes it can feel like nothing is being done. But at a higher level, I think in most cases, when there is a kind of persistent phenomenon happening, that justice is being served, and I think that applies to things such as crypto, where I have various friends and colleagues in various kind of organizations supporting catching these types of people, and there's a whole lot of information. They know a lot about this, and they're moving down a list and kind of prioritizing how to best help people is the way that I see it.
The introduction of the Bitcoin exchange traded funds, you might touch on that and explain that to people.
So Bitcoin and ETFs, crypto, digital assets, and ETFs in general, I think there's interesting overall phenomenon that we're seeing there. So long story short, I think that the more of these digital asset ETFs there are, the more critical mass there is for the overall space, but also the better it is for, say, hedge fund managers and asset managers such as myself. So point being there that when you see the kind of life cycle of an asset class, we're at the point where we're at an interesting point where there are historical comparisons. So if you take something like precious metals, when the gold ETF started to really hit the market, this is something where gold, to a certain extent, got a bit boxed in on price, where there was less price upside, but there was also a ton more liquidity. So it meant, though, then that some of the savvy investors started allocating more into some of the other precious metals, and also allocating more into kind of adjacent strategies beyond just buying and holding the number one asset, basically. And I think we're starting to see that in the crypto space, where once the kind of the top of the pile was your Bitcoin and Ethereum, et cetera, starts to be super public and liquid, the next logical step starts to be moving towards some of the mid cap and lower cap assets in the space, and towards more private and actively managed strategies that can basically harness more risk adjusted return, basically. So the other part is that I think we're going to start to see ETFs kind of moving down the list, so to speak, where we have Bitcoin ETFs, we have Ethereum ETFs. I think there are going to start to be more ETFs in sort of the top 10 assets, essentially, and start moving down the list from there, which I think will start to really catalyze the next sort of big bull market.
I mean, with all the different people that are investing, how would you kind of decipher kind of investing versus gambling?
Gosh, it's a very important question, and one that doesn't get asked enough, I guess. So yeah, there's a lot to unpack there. A couple of things. I mean, firstly, I think that a significant reason why digital assets have gotten kind of a controversial reputation is that a lot of folks that are kind of the most vocal tend to be talking or tend to be approaching it from more of a gambling perspective. I think that a common approach has been, okay, so this is a volatile emerging asset class, so let's make it even more volatile. And you start to see people where they're 100x leverage trading crypto futures and stuff like this, where yes, things could 1000x, but you could also lose everything, or you could lose more than you put in the first place, sort of a thing. So that's there is a lot of more kind of risk-seeking behavior in the space. What we're looking to provide to those that we serve is risk mitigation, where there's a lot of related areas there. One is basically to restrict things like the use of leverage, or restrict the use of high risk futures, so that the downside is mitigated. The other is to have diversified portfolios, where you have 30 to 60 different assets in the overall portfolio at any time, and where you're working to really make sure that that those assets have low correlation with each other. Because one of the risks is just to find an asset and say, oh, that looks cool because my friend said it was interesting, sort of a thing. And what might happen there is that it might just follow Bitcoin in price, or it might just not have sound kind of investment fundamentals or technicals. So really going through and doing research on an asset by asset basis, and saying, does this make sense as a part of a larger picture, is another area that we provide, and that we think is extremely important. So basically, you kind of have, in the investment approach to digital assets, is more discipline, research, evaluation, diversification, these sorts of things, which they may not be sexy, but they are extremely important, and they are in principle fairly straightforward, but they are in practice very difficult to do day in and day out when you see the asset tank or you see the asset 5x. Is very easy to get kind of emotions coming into play there as well.
And with the fund, is is it just private money, or can people use their pension for the investing?
Yeah, so there are a lot of different ways to invest in the digital asset space in general. It's possible to to invest into the space with with pension fund or with private money or various. I think it depends on the situation. I think a lot of fund managers, unless they are kind of exclusively managing pension money, will only accept up to a certain level of investments from pension funds, and that depends on the country in question. But that's a related point though as well in terms of risk management. That kind of ties your two most recent questions together. I think that what we're seeing with research, modern portfolio theory analysis, analytics from Forbes, ARK Invest, surveys of high net worth individuals, they're all kind of pointing towards a preference where they're seeing value in allocating between 1 and 10% of a portfolio into digital assets. So that can really depend on the person's kind of investment style, age, various other factors. But the overall point there is that a relatively small allocation into these kinds of assets can provide really outsized benefits in a risk mitigated way, where for most people it does not make sense to bet the farm on crypto, so to speak. That would in most cases be more gambling and less investing, depending on on the person's situation. But to have, say, 5% of assets in crypto and digital assets can provide very strong risk-adjusted benefits. Where, let's say, for example, if you had a $100 million portfolio for easy math, and you put $5 million into digital assets, that's something where if there are drawdowns in the space, 20, 30, 40% drawdowns, functionally you still have a $100 million portfolio if you have, allocations into things like stocks, bonds, real estate, for the rest of it. But then the thing there is that there's asymmetric upside opportunity where that 5 million, based, if it's properly allocated, properly, risk mitigated, all of this good stuff can well become, 15, 20 million. And then all of a sudden you have a $120 million portfolio, simply from a fairly small allocation. So there's asymmetric upside where the risk of kind of small, intelligently handled positions can basically make a huge difference in the overall situation.
And not with your company, but in general, and you've all these different investment funds and even pensions. I mean, you look at the BlackRocks and Vanguards and all this. I mean, I remember with my thing, they were saying, oh, if it goes up 6% or 8%, it's going to be worth this. And the second year, if it goes up 6 or 8%, it's going to be worth this. And it's it looks the exact same. And then it takes a little dip, and you're if there was full traceability, that I could see exactly what it is. They tell you it's in this fund, it's in that fund. But my experience from what I'm seeing with all the different investment funds, they're making the killing. When it goes down, they make the money. When it goes up, they take a huge chunk. But the individual whose money is being used doesn't really get main benefit from it. Is there ways that people can actually see what's going on, that they can fully track it? And it's, of course, if someone's doing great returns, the system can be you pay X amount or whatever it is what happens, and then on a bonus system for achieving certain results.
Yeah, that's That's a good question. I mean, I think there are kind of two main aspects of that I think are important to consider. One is kind of the let's say the performance profile of more kind of the established players versus more kind of the smaller guys, um, the emerging fund managers, things like this. And then the other is kind of the level of care and service. So on the performance side, you see, small emerging fund managers such as ourselves on average outperform, kind of more the giants of the industry that you're mentioning, because they are they're hungry, they're active, they have maybe a chip on their shoulder. It's that general market competition of a healthy market that you see, and that's something where in the end the investor into an emerging fund can really benefit extremely. And then the other part is the care and concern, where let's say someone who puts $1 million into kind of a titan, that's their often they can just be another number on the balance sheets, like what you're saying. Whereas with a smaller kind of more hands-on type of a group, it's that same investment amount could be more provide more real kind of concierge service, essentially, where you're a number one priority. I think that's you could say the same of a lot of other business models that basically we want to avoid situation where there are monopolies, and there is a growing concern that there could be a monopoly type of situation where it's something like the top five kind of funds and asset managers globally manage something crazy, like I believe it was about 90% of the assets. So having that basically having that opportunity to support healthy competition is something that investors can really benefit from, not just on the return side, but also, to your point, on the knowing what's going on side, where they can get on calls, they can ask questions, they can know what's going on, they can kind of have their questions and concerns answered in a much more hands-on way.
Like if we look at, like, say, the competition authority, like all these big boys, they all own shares in each other. Vanguard owns shares of BlackRock and Fidelity and all this. But if you look at even, say, the media, like, it's only that they use that, I think, for the small boys so they don't have competition, because it's corrupted every industry. And like, how are they allowing, like, say, 5 corporations own 90% of the media? The same with the banks, like they bail out banks, and then they're buying the ones that fail at pennies on the dollar. And it's kind of, it's like it's very hard for the likes of the smaller boy to compete with them then.
Yeah, I mean, I think this that's a good point, and a comparable situation in another industry that comes to mind is food, where a choice is an illusion. Where walking into, say, something like a mainstream supermarket, you have you're trying to decide between 5 different brands. Chances are that at least 3 or 4 of those brands are actually owned by the same kind of ultimate beneficial owners, same ultimate holding company, right? And then similarly to your point, in something like the food industry, a lot of the subsidies and kind of a lot of the benefits often get kind of clustered at the top, whereas increasingly people want to eat local, eat organic, supports small businesses, something that can really benefit their own health, where it's kind of fewer pesticides and fewer processing and things like this, but also benefits kind of their economy as well. And I think that's a similar situation here, where kind of going a bit smaller can benefit the kind of the end consumer, but also kind of benefit the economy as well.
And You're a partner and board director of ChainBLX. You may just explain exactly what you're doing there.
Yeah. So I guess to continue that food analogy, this would be a bit like a farmer's market. So rather than having any one fund manager on their own, which is more, say, like the fruit stand on the side of the road, this is like a farmer's market where it's a central platform or location for a group of fund managers. So basically, this provides a lot of benefits to have a broader ecosystem where there's basically lower setup and maintenance costs for the fund managers involved, because there's kind of that cheaper by the dozen type of unit economics there in many ways, but also something where clients and investors can benefit because they can go in and kind of pick and choose, to, say, allocate into different flavors of assets, so to speak. And then there's also ability to basically cooperate across the board of, say, exchanging, kind of reallocating between different asset classes as well, kind of shifting the amounts that are in crypto versus real estate versus AI, shifting those amounts in secondary exchange, essentially.
Just finally, like one thing that I'm kind of conscious, like I've asked a few people on it, is like with the crypto and you've got your wallet, and for inheritance, you get hit by the bus in the morning, and usually people aren't giving their loved ones because they're afraid. Have you a system, or do you know of a good way that you can actually, because you can't give it to your solicitor or your accountant, because they're a lot of them are as fraudulent as the thieves on the street. So have you thought of a way that you can actually make sure your loved ones get what you want if the worst happens?
Yeah, that's an important question for sure. That's basically succession planning, legacy planning. These sorts of things are very important. I think that ties back to a previous question you were asking about kind of the systems that are in place, where most kind of solutions that are most readily available to people on the everyday that have kind of less familiarity with the space, or just if you go and Google where to put my crypto, sort of a thing, you often get systems where on the one hand, if they're centralized, it's something that could be very easily kind of taken away from you in that kind of gun to your head type of scenario. But then if it's decentralized, could be very easily inaccessible to your loved ones or your business partners in an event where you're incapacitated, or if this is after you're deceased, or things like this, right? So with that in mind, I mean, there are always levels and levels of solution. I would say something that people can do on more of a DIY, do it yourself type of level would be things like setting up multi-signature wallets where say your lawyer has one piece of approvals and your business partner has another piece of approvals, and your family maybe has another. So then they kind of need to come together to basically be able to access that. And so it reduces the risk of any one individual sort of becoming not trustworthy. But beyond that, on a more kind of institutional level, is to have, to be involved with a fund manager that works with, a third-party auditor, that works with, an administrative partner, where there's basically, a legal paper trail of these assets being, owned and custodied, and where that can be, in a will and easily accessible to, loved ones and others kind of involved in the estate settlement, but also where there is planning around basically mitigating external risk of someone trying to come in and hack, and where there are those insurance policies in place and things like this. So it's kind of one of those things where it depends on the level of care and attention needed, but that might not make sense if it's $10 in crypto, but it might make sense if it's $1 million in crypto, sort of a thing.
Love it, love it. Listen, David, thoroughly enjoyed the conversation. You might let people know where they can find you.
Yeah, absolutely. Thank you again for having me, Roy, on the show. And I think you asked some important and insightful questions. Just is always nice to be seeing those as a guest on a show. Yeah, in terms of ways to get in touch with me, with my team, I'm pretty active on LinkedIn. I publish a lot of content there myself personally, as well as our team company LinkedIn page. My LinkedIn handle is David Ambrose Doss, and then you can also reach out to me via email, david@CKC.Fund. And then you can also visit the CKC.Fund LinkedIn page. We have a newsletter that we put out there to help educate people on the space, what's going on in the markets at given points, or what some of the trends are, these sorts of things. So happy to have more kind of one-on-one conversations as relevant, but also we're looking to just be out there helping to educate people on some of the do's and don'ts, the possibilities that are the amazing possibilities in the space.
Perfect. I'll make sure I put all the links both on the audio and the video, and when I put in the email, I'll put a bracket around it, because otherwise you'll get all the bots that will be bombarding you. So we'll make sure that doesn't happen.
Thank you. Yes, that's very helpful. Yeah, happy to talk with people. Bots, less so.
Thanks very much, David. That's all for the Crypto Podcast. Make sure to comment and let us know what you thought about the points that we talked today. Give us a thumbs up, 5-star rating, share with your friends. Until next week, take care. So I hope you enjoyed this week's episode. As mentioned at the start, you'll find my 6 podcasts on bio.link/podcaster. And also, if you'd like to start a podcast or do a podcasting tour, you'll find the information on that or on the QR code that's there. Be sure to give us a thumbs up, 5-star rating, and share with your friends, because it really helps. Until next week, take care.